Hey, I'm Jason Coleman, mortgage broker with Price Mortgage, and today we're going to go over the differences between loans. Since we have 2 hours and we're headed to Prescott to go visit my mother-in-law, Anne. So a lot of people have been asking, what are the differences between loans? And there is a lot of differences, so I hope you go grab some popcorn and get ready. So we're going to start out. There are two different kinds of loans basically. There's your government loans and then there's your conventional loans. So government loans are Ginnie Mae, that's what they call them, Ginnie Mae loans. And then you have your Fannie Mae and your Freddie Mac loans, okay? So what falls under Ginnie Mae loans? Your FHA and your VA. And then you have also your USDA loans, which are government loans as well. Now technically, all of these are government loans because the government owns Fannie and Freddie. And they were thinking about putting them back into conservatorship, which means going back to private. But yeah, not so much. They're making too much money, I guess. So let's start out with government loans. Government loans are usually priced, the interest rates are usually lower, with maybe the exception of USDA. Now, they all have funding fees, okay? USDA, FHA, and VA. They all have funding fees. What is a funding fee? Well, a funding fee is a fee that these agencies add on to your loan after you put your down payment, and it varies from loan to loan, and depending on how many times you've used like your VA eligibility. So first time use on a VA eligibility is 2.3%. It just went up 0.15, and after you've used it one time, then every other time you use it, you will be charged 3.6%. Now there are variations to this. If you put down 5% or 10% on a VA loan, you're going to get a lower funding fee, okay? Now FHA is always 1.75% no matter what you do. I think if you put down a little bit more, it may go down. I'm just going off the cuff on these. And 1.75%, so you put down 3.5%, and they'll add back to your loan 1.75%. And they always have mortgage insurance for the life of the loan on FHA. So that means that you have to refinance out of the FHA into a conventional to ditch the monthly mortgage insurance. Even if you put down 20%, they're still going to tack on mortgage insurance. So it's 0.85, that's the mathematical factor to figure out your monthly ratio. So then you have USDA. It also has a funding fee. I think it's around like 2%, and it has a small monthly mortgage insurance as well. But that is 0% down, and you have to get online to figure out if your zip code qualifies for that USDA no money down loan. Okay, it has to be in a rural area, considered a rural area for your area. So VA has no limit as long as you qualify, you know, and they say it's 28/41% on the ratios, but it really goes off of residual income. So there's four different areas of the country, you know, like West, Middle West, East West, and East and Middle East or something. So each one of those have a different residual calculation. So if you go there and you're in Arizona and you decide, okay, I have 4 people in my family, then you have to look at how many, is it a single family, is it a duplex or a triplex or a fourplex, and what is the residual income that I need to satisfy in order to qualify. So I've done loans that have loan to values debt to income ratios up to like 60-something%, but they had the residual income to qualify for the loan still because there were only 2 people, and you know, the automation approved it. So also between Freddie Mac and Fannie Mae and FHA, your debt to income ratio on FHA can go up to as high as 56%. Now you have to have compensating factors to get to that level, okay? And some of those might be reserves in the bank, like you have an extra couple months of reserves in order to meet that. You can't buy an investment property with FHA, you cannot buy an investment property with VA, and you cannot buy an investment property with USDA. Those are all primary home loans, okay? So now let's flip over to conventional financing, Freddie Mac and Fannie Mae. So the interest rates are a little bit higher, usually about 1/4% higher than the government loans, but the mortgage insurance will range depending on your credit score and how much money you put down. Another difference between Fannie and Freddie is when you're calculating student loans. So on Freddie Mac, you get hit with 1%, and with Freddie Mac, you only have to calculate 0.5% of the balance that shows on the credit report. So let's say you have a income-based repayment program and you owe $32,000. Well, we still have to hit you with that 1% or 0.5% calculation for your monthly payment to figure out your debt to income ratio. Okay, so if you have like a 680 credit score and you're putting down 5% versus 720 credit score putting down 5%, your monthly mortgage insurance is going to be different. It's going to be lower if you have a lower credit score. So it depends on the risk on how much they're going to charge you on a monthly mortgage insurance. Now, down payment assistance, it can go along with all these loans, okay? Obviously, for VA, you don't need down payment assistance. USDA, you don't need down payment assistance because both are 0% down, okay? So FHA has down payment assistance, and so does conventional. Conventional has multiple down payment assistance, and, as well as FHA. So the some of the down payment assistance available are grants. You have the Neighborhood Stabilization Program, where you have to stay in the home for 15 years before they forgive you for that loan. You have grants on FHA where you can borrow 3.5% and they'll charge you a high interest rate like 6.25%, and then in 6 months you can refinance and be forgiven. You can streamline and be forgiven that 3.5% down. So you also have the Maricopa County, for us, the IDAs, and they can help you anywhere from 1, 2, or 5, all the way up to 5% with down payment and closing costs. Now that can ride along with Home Ready or Home Possible, which is Fannie Mae or Freddie Mac low income loans, and those low income loans are under $62,000. It just recently changed, so don't quote me on that. It's 63 or 64 or 62 or somewhere in there. So if you make under that amount of money, you can qualify for Home Ready or Home Possible, and you can combine that with a IDA. Now, as a mortgage broker, I don't do the IDAs, I only do the grants. So, but in this market right now here in 2021, getting an offer accepted using down payment assistance is pretty rare. I mean, you would have to really get lucky to find that gem of a seller that's going to accept your down payment assistance, because it does say on the prequal that you're using down payment assistance, and with everybody overbidding, chances are you don't have the money to overbid and pay the difference or waive your appraisal, if it comes in low of the purchase price if you overbid. It's just what's happening right now. So using down payment assistance right now is rough. Even VAs are rough. Even USDAs are rough, but it's probably not as much competition out in the rural areas. Although everybody, with the COVID is finding it's easier to work from home now. they figured out ways to work from home and they enjoy it. So they are buying in rural areas right now. So with Fannie or Freddie, pricing is really heavy when you have lower credit scores. You have a lower credit score, say a 640, the minimum is a 620 to get into to refinance or purchase, but your rate's going to be really high because they have these 1 or 2% adjusters on the back end of the rate. With FHA, it's not such a huge hit to the adjustments of the rate when you go that route, and it's just a lot more flexible when you go with the government loans. You know, higher debt to income ratios, and it's just so much easier, less reserves required. Now, if you're trying to purchase a second home, which is 10% down, it has to be, I don't know, 50 miles, 100 miles from your current residence. The mortgage insurance is pretty good, and you have to have a pretty decent credit score in order to qualify for that, and you have to have reserves. So if you're buying a second home, you have to have 6 months reserves of that new payment, and you have to have 2 months reserves of your current mortgage payment. And it has to be, you know, like I said, a nice distance from your home. So it's like a vacation home. So investments are 20% down, and the interest rates are usually 1% higher than the going primary residence rates. The second home rates are the same as primary residence rates. So the only exception to 20% down on the investment purchases are 25% down if you're buying like a non-warrantable condo. Now, it's very difficult, if not impossible, to buy a mobile home, manufactured home as an investment property. Okay, so that is a difference. Typically, you're only going to get primary residence on the mobile homes, unless you already own it. Then and you're trying to refinance and you're renting it out. That could be difficult as well. I just don't see that happening. So those are some of the major differences between FHA, VA, USDA, which are all government Ginnie, and then you have your Fannie and Freddie, which are considered conventional. So trying to figure out what's best for you, you're going to have to run the numbers and see how much mortgage insurance you're going to be paying for, and that's going to, it might be lower payment by 10 or 15 bucks than the conventional route, but you're getting 1.75% added to your loan. Or with VA is always a great loan. I mean, no mortgage insurance and no down payment. You can't beat that. So thank you guys for serving. You deserve the loan, and that is definitely hands down the best loan that there is in the market. Absolutely. Lowest rates, no mortgage insurance, no money down. So when you're figuring out, your APR is going to be much higher, your interest rate is going to be lower on an FHA, and you're going to say, oh, well, the rate's lower, but the mortgage insurance might be cheaper if you have a good credit score to go with the conventional, right? And your payment might hit your principal heavier if you go with the conventional versus if you go with the FHA. So it's always good to make one extra payment a year. That the first 5 years of every loan, every 30-year loan, is 85 cents of every dollar goes towards interest. So it's very important that when you take a 30-year loan out, you pay extra to the principal every payment, and that will drive the terms of your loan and save you tens of thousands of dollars in interest. So let's say your payment is $1,200 a month, which is pretty low, and you pay an extra $100, that's one extra payment a year, then you will drive that 30 years down to like 22 or 23 years. You can do the math, look at your amortization schedule, and figure that out. And that goes for every single loan. Although when you take a 15-year or 20-year, you save a lot of interest, your payments are way higher, and it's harder to qualify, especially with the rising values right now across the nation. Now, I hope this video was helpful to you, and in explaining the differences. There are a lot of guidelines that go along with each one of these loans. They all have different loan debt to income ratios. I didn't mention that conventional has a 49.9% max debt to income ratio, and on cash out refinances going over 45%, you must have the reserves in the bank in order to go over 45%, even when you're doing a cash out. So there's a lot of guidelines. A lot of banks have overlays on each one of these loans, so you have to see which banks are doing no overlays. If you have a specific scenario, maybe you had some crazy things happen in your life and it affected your credit somehow, you know, it happens to the best of us, and you just have to check and see if that's available. Self-employed people right now, because of COVID, are being asked to do a profit and loss statement for the year, which matches up with their bank statements, and it can be a real challenge to get that done if you don't already practice that, which a lot of business owners, I'm finding, don't have a clue on how to do profit and loss statements. I hope this video is helpful in explaining some of the differences between all these different loans. If you have more questions, I'm going to put my phone number at the bottom. Reach out anytime. I work 7 days a week, and love to take your call, love to answer your questions. And until next time,